I had an acquaintance stop by my house the other day. We were spending a little time together, and I hadn't seen this guy in a little while, and he asked a question. He said, "Hey, how's your company going?" And I said, "Oh, things are going great. We're very excited about a new product we're offering." And he said, "Oh, that's interesting, because I knew you guys were selling informational products, and I knew you'd done a lot with financial stuff, and now you're actually making something like that available. How come you guys chose to do that?" And the thought was, well, how much time do you have? That's what kind of ran through my head, because there are a lot of reasons behind it. And I wasn't able to give him a long answer. We were heading out the door. But I thought that I would share a little bit of the answer. Had I had time, what all would I have told him, what the reason would be for us coming to the market with something like that, and why we're so excited about it. And immediately I thought of a joke that I heard from Christian comedian Tim Hawkins. And he talks about how certain tendencies people have when they pray, and some of the funny things they do when they pray, and the peculiarities that they'll do. And one of them that I remember, my kids walk around the house laughing about this one all the time, is when someone prays a hedge of protection around someone. "Lord, we just pray a hedge of protection around Brother Bob." And then the comedian Tim Hawkins says, "Oh, along comes Satan. I'm going to tempt Brother Bob. I'm going to pull him into some grievous sin." And he comes along all ready to destroy Bob's soul. And what does he find but a hedge of protection, a bunch of shrubs growing up around Brother Bob, and kind of funny, because that's not really what's meant in the prayer. They don't really mean a hedge as though a bunch of shrubs. What they're really referring to is something, almost a financial term, a hedge, which means a way that you offset risk in another area. For instance, a simple financial hedge where you use one financial device to offset your position in another financial situation would be buying options, buy a put option. Let's say you own some stock in a company. Let's say you bought some GE stock, and you're worried that it might go down in the short term, and you don't want to take that loss. You bought the GE stock. You're holding it for the long term, so you're what they call long GE stock. You're counting on it going up. But you're a little worried about the short term and it taking a bath because of some of the things that are happening. Maybe the presidential election has you scared or whatever, and you don't want the stock to go down too far. And so you buy an option. You buy what's called a put option. And that gives you the right, not the obligation, but the right, if that stock goes down in the future within the term of the put contract, to sell the stock at the price at which you bought the contract back when it was still high. So if the stock goes down, you've got a contract where you can sell the stock and get the money that you got way back when you bought the contract. If it doesn't go down and the GE stock that you own goes up, you get the gain, and all you're out is the amount of money you spent buying the put option contract. And so that's a real simple way of hedging a financial position. And we've all heard the term hedge your bets. Well, that's really what it means. And that's what Tim Hawkins was talking about when people pray a hedge of protection around Brother Bob. And I don't even know if people realize they're using a financial term when they make such a prayer. But anyway, that's what hedging is. So to really dig into this and really answer this acquaintance of mine, why we chose to make this product available, I wanted to go to some things I got from Warren Buffett, because I really want to talk about hedging and what some of the experts say about gold. And if you've gone through our Beyond Financial Fitness product pack, which we're very proud of, it's designed to go from, to take off where the Financial Fitness pack leaves off, to pick up from there and go the rest of the way. Because the Financial Fitness pack introduced the concept of the offense, the defense, and the playing field of personal finance. And it really kind of taught people that there are those three things. The defense means that you get out of debt and you shore up your resources and learn to save and learn to prepare for different things that could happen. The offense means to gather additional streams of income and increase the income that you make and just get more coming in. Go on offense. And then the playing field is a consideration of the environment that you play the financial game in. You've got interest rates, and you've got the Federal Reserve doing things, and you've got the political situation, you've got regulations and taxation, and they all have to be thought about and properly handled in order to grow your financial standing. And so we introduced that three-part concept, but then really the overall feel when you go through the Financial Fitness product pack, the original one, is really how to get out of debt and why. And we really needed to pick up from there and dig into what do you do now that you're out of debt and you're not spending and wasting so much money paying the interest on that debt. Now you're starting to prosper and you've got this money coming in. What might you do with it? And so the Beyond Financial Fitness Pack was designed to not give financial advice, but to give financial literacy, to teach some of the things that the experts recommend in terms of what you might do as you start to prosper and get that positive cash flow coming in. And one of the things we talk about in there is bullion gold and where it fits in the overall scheme of all the assets that are out there. Well, if you've read the Beyond Financial Fitness book, if you've gone through those materials at all, and if you haven't, I hope you do, what are you waiting for? If you go through that, you're going to see that one of the experts that we quote a few times in there is Warren Buffett, one of the world's most famous and certainly one of the most successful investors of all time. And he's a man I really enjoy listening to his speeches, reading the things that he writes. He doesn't keep secret what he's done to build up this enormous wealth that he's built up to make this great investment and company that holds all these other properties and companies. And he writes these really interesting annual reports every year for Berkshire Hathaway, and he writes them himself, and they're very folksy, very easy to understand, very intelligent, as you would imagine. And I've read them all, and I really enjoy going through those. And one of them, he talks about 3 types of overall asset classes, the way he looks at the world. 3 types of overall asset classes. And the first one, he calls them currency-related securities. Now, what does that mean? Currency-related securities means things that you put your money into that are denominated, in our case, in dollars, and it's all a matter of dollars. It's all measured in dollars. It's produced in dollars. It would be things like bonds, which pay interest, but it's all calculated based upon the number of dollars you put in and the interest they're going to pay back on those dollars over time, and then a market price that fluctuates on that bond, all denominated in dollars. Or annuities, where basically you give a bunch of money, you sign a contract, you give a bunch of money, and the annuity contract promises you a certain amount of money in the future on a regular basis as long as you should live. Now, it's much more complicated than that, but that's a generalized idea about annuities. And CDs, certificates of deposit, money market accounts, bank savings accounts, which supposedly pay a little bit of interest, and those types of things are called currency-related securities. They're entirely based on the currency itself. And Buffett had this to say about those. He said, high interest rates can compensate purchasers for the inflation risk they face with currency-based investments. Current rates, being so low as they are right now as I make this video, however, do not come close to offsetting the purchasing power risk that investors assume. What he's saying there is that if the interest rates prevalent in society at the time are high, that offsets the risk that you may offset the risk you face by being involved in those investments, because inflation is going to eat away at the value of what you've got there, and it might eat all the value away. As a matter of fact, if you just put your money in a checking account right now and you get the little bit of interest they pay, you're going backwards, because inflation is certainly higher than that little bit of money they're dribbling to you for having your money in the bank. And that's what he means. And he goes on to say that in his mind, for him, that would be one of the riskiest asset classes right now because of inflation, and the interest rates are so low. The second class that he talks about is, he calls this one assets that will never produce anything. And he says this, quote, owners are not inspired by what the asset itself can produce. It will remain lifeless forever, but rather by the belief that others will desire it more avidly in the future. The major asset in this category is gold. Well, that's interesting. He's talking about what we're talking about here. And what he's basically saying is this type of asset doesn't do anything. The gold is never going to do anything. It's not going to get up and produce some more gold. It's not going to produce anything. It's just going to sit there. And that's what he's talking about. He says the third category is what he calls productive assets. These are businesses, farms, real estate, things that actually supposedly should produce something. And Buffett says, quote, ideally, these assets should have the ability in inflationary times, so even in the inflationary times we're talking about in the currency-related securities, to deliver output that will retain its purchasing power value. So because they produce something, because they multiply, they can outrun inflation better than all these other things, and for that, he says that obviously is his preferential class to invest. And he and his partner, Charlie Munger, they have a very narrow view. They say they only understand a little band of businesses and assets, and then they just stick to what they know, and it's in that category, and who can argue with their results? But interestingly enough, in this particular write-up, he goes on further to talk about asset class number 2, and particularly he singles out gold. And he says this, and let me just give you some background. And the first time I ever read this, I almost couldn't believe it. And I had to do some research, and everywhere I go, everybody seems to verify this within a percentage of each other that this is effectively true. If pretty much all the gold in the world that's above ground that we know about, that's in circulation, is very close to the amount that we've had all through time. Now, they mine some every year. I think it's about 78 million ounces a year that come in, something like that. But that's not a lot when you talk about the fact that we've got somewhere between 4 and 5 billion ounces of gold on the surface of the earth in circulation, on jewelry and those type of things. But everybody, all these experts seem to say that if you could somehow get all that gold, all the gold we know about, melt it down and put it in the shape of a cube, it would be somewhere between 60 and 68 feet per side, which means all the gold in the world would fit in most people's backyards. 3 stories tall or 6 stories tall sitting there, whatever that is. Everybody would come over and look at it for sure, and it would probably sink down through the earth because it would be so heavy. But that's not very much. It just doesn't seem like that much. And currently, as I'm giving this talk, gold is at something like $1,350 per ounce is the spot price for gold. So if you multiply the price per ounce by all the gold that we know about in the world, you get about $6.7 trillion worth of value. Now, just to put that in perspective, because when we start talking trillions, all of our heads kind of spin. The U.S. Gross domestic product, which means the total financial output of the entire United States in a year, and the last year I could find was 2013, was $16.7 trillion. So almost $17 trillion. So all the gold in the world is only worth just a little over 1/3 of the annual output of the United States in just 1 year. So what Buffett goes on to do is it's a very clever little argument. He says, picture this. Picture pile A, all the gold in the world, that 68-foot by 68-foot by 68-foot cube sitting in your backyard, standing there all golden and shiny, everybody coming over to take a look at it. Picture that pile worth $6.7 trillion right now as we speak, pile A. He said, compare that to pile B, and pile B would be all of the cropland, all of the crop farmland in the United States, which is about 400 million acres, and 16 ExxonMobil companies, which is the most profitable company in the world, usually one of the top 2 or 3 most profitable companies in the world. So pile A is a 68 by 68 by 68 cube of gold. Pile B is all of the farmland in the United States, 400 million acres, and 16 ExxonMobil companies. And here's what Buffett says. A century from now, the 400 million acres of farmland will have produced staggering amounts of crops. ExxonMobil will probably have delivered trillions of dollars of dividends to its owners and will also hold assets worth many more trillions. And then here it is. Here's his final nail in the coffin. He says this: can you imagine an investor with $6.7 trillion selecting pile A instead of pile B? Now, I love that argument. I remember reading it the first time and really being taken by it, but you have to look very close at what Buffett's doing there. It's something in Latin that they call reductio ad absurdum. It's a term that describes a debate technique where you reduce something down to the point where it's ridiculous in order to make your point. You prove a contention by making the opposite of it so ridiculous that obviously it's true. What he's done is he's gone to extremes to try to show that this asset class is better than this asset class. It's very clever, it's very effective, and it makes his point very strongly. But it does beg the question, why are we restricted to choosing one pile or the other? In the investment world, it doesn't work like that. We're not restricted to making one asset class choice. The question I thought after reading it was, well, I don't think anybody has ever said you would take pile A. I think what most experts say is, can we have some of pile A? The answer would be, can we have both? And I'll get into exactly why in a second. Here's part of it. The wisdom of choosing pile B, all that farmland, and that productive oil drilling and producing company, all of the wisdom that says, yeah, that's a really good idea, is propped up by a list of assumptions. Assumptions such as that we will continue to have a capitalistic society, that we would be able to share in the profits off the crops and the oil, that we would have reasonable regulations that would continue, that we would have contained and realistic taxation, that we would still be allowed private ownership, that there would be freedom, that there would still be capitalism, that there would be a stable money supply in which to get compensated for that output, that contractual law would allow us to have claim to what we think we own, that natural resources could be used for private profit, that fossil fuel consumption will still be legal. That, there are some extreme considerations that say, man, that stuff shouldn't even be legal. It's wrecking the earth. And so choosing pile B only for 100 years stands on a whole bunch of assumptions that may or may not hold true over time. Interestingly enough, all these things I listed, sound money, capitalism, private ownership, reasonable regulations, inflation against the money, all those different things, the losses of which gold is designed to protect against. And now we get back to the hedge of protection. The reason someone would want to walk up with a little saw and carve out a little piece of pile A, even though he's going to invest the rest of his money in pile B, is because that little chunk of gold from pile A can protect against a lot of those assumptions should any of them start to erode and not be true. And in lots of countries throughout the history of the world, this whole stack of assumptions have not held over time. You and I, in the Western world, in relatively free countries with decent economies and prosperous laws and capitalism and private ownership and relatively stable money, right now, under that list of assumptions, it looks like pile B. But you don't want to bet everything on pile B. And so let's go to what some of the experts say about choosing both. Let's not take it from me. Let's go to some of the experts. Ray Dalio is the manager of the largest hedge fund in the world, Bridgewater Associates. It's worth somewhere around $156 to $160 billion worth of assets under his management. Pretty impressive. He recommends to have 7.5% of your portfolio in gold, and that we put that information in the Beyond Financial Fitness Pack with a lot of other details you can read there. Stan Druckenmiller is the chairman and CEO of the Duquesne Family Office, and he's generated an unparalleled annualized return of over 30% through his entire investing career. He said on May 4th of this year, CNBC first said, the billionaire investor, Stan Druckenmiller, expressed skepticism about the current investment environment due to the Federal Reserve's easy monetary policy, among other things. Druckenmiller said this, gold remains our largest currency allocation. Not just walk up to pile A and carve off a little piece, but it's our largest currency allocation. It's the biggest thing that he has in the portfolio that he's managing. Bill Gross, who runs the $1.5 billion Janus Global Unconstrained Bond Fund, said this, I don't like bonds, I don't like stocks, I don't like private equity. Real assets such as land, gold, and tangible plant and equipment at a discount are favored asset categories. So basically he's saying, I want a little bit of both piles. He's listing parts of both pile A and pile B. Jeff Gundlach, who manages more than $100 billion in assets at Double Line Capital, said, sell everything. Gold is a better bet these days, even as prices are currently at the highest level they've been at in more than 2 years. Now I think that might be one guy that's saying all of pile A. Todd Colvin, the Senior Vice President of Institutional Sales at Ambrosino Brothers, said, gold has an unlimited upside because the Fed is confused on policy. And he went further on to say, gold is in a bull market that will only come to an end when the central banks take their hands out of the cookie jar. Now, what does that mean? Well, you should probably listen to our audio that's in the Financial Fitness Pack called Camel in the Tent, and we talk a lot about what happens when the Federal Reserve inflates the money supply and devalues the spending power of the dollars that you have in your pocket. We cover that a lot also in the Beyond Financial Fitness Pack, and we talk about some of the things going on there. But that's what's being said by Todd Colvin. Billionaire hedge fund manager Paul Singer says it makes a great deal of sense to own gold. Investors have increasingly started processing the fact that the world's central banks are completely focused on debasing their currencies. What that means is printing more money so the government can get itself out of its debt situation easier, and at the same time dropping the value of individual currency notes that people hold in their hands. The Physical Gold Fund board member and best-selling author James Rickards wrote, "I don't see a correlation between stocks and gold. There is a place for both in a carefully selected portfolio. The right portfolio is one that has a good mix of assets, with gold being about 10% of the mix." So again, there's somebody recommending going up and cutting a little piece off of pile A. Alan Greenspan, who was the chairman of the Federal Reserve for years. Lots of people blame him largely for putting the punch bowl there that all the investors got drunk on with the free money to begin with, said gold has a special property that no other currency, with the possible exception of silver, can claim. And he goes on to talk about how gold stands alone and it stands up to the test of time when fiat currencies come and go. John Paulson, billionaire hedge fund manager, says, "We view gold as a currency, not a commodity. Its importance as a currency will continue to increase as the major central banks around the world continue to print money." One editor-in-chief of a big financial magazine said, "Gold is constant. It's like the North Star." Kyle Bass, I got a few more of these, then we'll move on to the points I'm making. Kyle Bass, Texas hedge fund manager, and one of the guys who successfully predicted the U.S. subprime mortgage crisis that happened in 2008, said, quote, "I'd much rather own gold than paper. I just think they can't print any more of it." Gold, that is. "They can mine some more, but they can't mine it at the rate central banks can print paper." That's a really good view of what gold can do. Some of these experts we're hearing are saying it's not a commodity, although it's traded with futures on the commodity exchanges. It's treated as a commodity in the baskets of what most people consider commodities. But these experts are saying they consider it a currency that doesn't move, even though the fiat paper currencies do. And as governments print money and issue digital money that outruns the supply, gold stays constant. And when you park some of your wealth into gold, it freezes your fruit in a store of value that no one can tamper with. Kevin O'Leary, for those of you that are Shark Tank fans, he's the guy on there that terms himself Mr. Wonderful. Kevin O'Leary, also a billionaire on his own right and a fund manager, said this. He said, quote, "I like gold because in a way it's a stabilizer. It's an insurance policy. I've owned gold for decades. It's worked for me in portfolio management. It's the only security I own that doesn't pay a dividend." So basically it's so important, even though it doesn't pay a dividend, even though it doesn't produce anything, it's important enough to him to stabilize and become an insurance policy. Jim Cramer from Mad Money, the founder of TheStreet.com and the guy that rings the bells and smashes stuff, and somebody's very entertaining. He said this, "Why do I like gold?" I need to say it like him. "Why do I like gold?" I can't talk as quickly as he does. "Why do I like gold? Because gold tends to go up when everything else goes down. It's your insurance against economic or geopolitical chaos, uncertainty, and inflation. Before you curse me out because gold's done nothing for a couple of years," by the way, he said this back in 2014, gold's done a lot since then. "Remember, you wouldn't own a home without homeowners insurance. You wouldn't own a car without car insurance. It's also been the best performing asset year after year for the last decade, racking up gains consistently over a period where at some point every other asset class has disappointed you." Ron Paul, former Texas congressman, said 6,000 years of history shows that gold maintains its value and paper currencies always self-destruct. Frank Holmes, the CEO of U.S. Global Investors, said, "Gold is the great universal consolidator of value. Owning gold in good times can be as rewarding as watching paint dry. But because it comes into its own whenever there is uncertainty, owning gold is something to keep in mind when making risk management plans." One more. Authors Jeff Little and Lucian Rhodes wrote, "History tells us that gold does not create nor can it prevent business cycles. It is, however, a viable hedge, there it is, against the problems that result from excessive investor speculation or from the mismanagement of the economy. From the day the first grain of gold was discovered, it has been a universally accepted treasure as a viable medium of exchange. People turn to it during periods of uncertainty and concerns about the economy. Actually," they continue, "the world will always be on a gold standard. Only governments and their policies change." Now, I got that from a book that describes the inner workings of Wall Street. It had nothing to do with gold, and these guys just put that aside in there about gold and why some people want to use it as a hedge, as you saw in there, referring us back to the original prayer. So we might not want to buy all of pile A with our $6.7 trillion that we came into, but hearing from these experts certainly seems to suggest we might want to saw off some of it. And listen to the things that we heard through all these, and I could have found more, and you're probably glad that I didn't. But listen to the things that were said throughout all of these experts and their opinions. That gold is a store of value, that it's a type of insurance, it's a favored asset, it has special properties, it's a currency, not really a commodity. No one can print more of it. It's safe from tampering by central banks. It's a stabilizer. It goes up when everything else goes down. It maintains value. It's a universal consolidator. It's a universal consolidator of value. And it's a hedge against calamity. But there are even some more considerations, and these are a little bit interesting. The first one is something called cyber financial attack or cyber financial wars. In 2014, Bloomberg Businessweek broke a story called, quote, the NASDAQ hack. The NASDAQ hack. With the help from the FBI, the NSA, and the Department of Homeland Security, the NASDAQ, which is it's an electronic exchange of a whole bunch of, they're not stocks that are listed on the floor, exchange and actively traded on the floor. They're stocks and securities that are traded through electronic means, through basically a big computer system, which is the NASDAQ, National Association of Securities Dealers. They run this big international electronic exchange of all these securities. The NASDAQ actually found a computer virus in its operating system, determined that it was an attack virus, and it had been planted by the Russian government. This was an official state attack on a major stock exchange, a security exchange that took place. And on August 22nd, 2013, the NASDAQ was down for half a day, many suspect as a result of that attack. So this is just an extraordinary case of someone's hacker being better than our hacker defense and actually intentionally coming in and trying to wreak some havoc. This could happen from state-sponsored entities like apparently that one reported. It could also happen from individuals. Whenever you have something that's digital, it's now up for digital grab for someone who's smart enough to outfox any security that supposedly protects those digits in a computer memory chip or in a flash drive. The second consideration is something called bail-ins. Now, you've probably heard of bailouts. Do you remember the 2008 financial crisis, and all these big banks were going to go under and they were too big to fail, and so government money was given to them in the form of TARP, trouble asset gifts that were given, and some loans. These were bailouts by the government to bail out these troubled financial institutions. Well, there's something called bail-ins. It's a little different. This is when a bank is in trouble and depositors, little people who put the money in, hoping to have it be safe in a bank and earn a little bit of interest. This is when depositors don't get all of their money back when a bank is in trouble. A bank might come out and just say, sorry, I know you gave us $1. We can only give you 85 cents. That's all you get. That's a bail-in. They need the 15 cents in order to remain solvent. That's a bail-in. You might think, well, we have FDIC insurance in the United States. There's no way that could happen to me. Well, the Federal Deposit Insurance Corporation, FDIC, which was put together to be a buffer against something like that happening if a bank should fail, it only goes up to $250,000. And you might think, well, that's a lot of money. I got that much in there insured. Yeah, but what if you sold a house? What if you were about to move and you sold a house and your house was worth a bit more than that, and you had to deposit the money through the bank before it could then be put into another check to be put down on the next house that you're buying? And what happened if the bank failed at that moment and it were more than that? That amount wouldn't be insured, and you'd be stuck in a bail. And you say, yeah, but that's very unlikely, and it is. Thank God it's very unlikely. But it did happen in Cyprus in 2013, and it did happen in Greece in 2015. So it's not just a hypothetical threat. It's something that's actually happened on the planet in a couple spots. It could happen anywhere. It probably won't, but it's something to consider. But what I want to drive the point with just those two things, the risks of cyber attacks and then the risks of bail-in, these are two concerns that are really tied to a trend. If I had a way to draw it out, I'd do it here. Maybe I'll draw it on this wall. Maybe I won't. But if you picture the evolution of money in just the past century or so, about 100 years or more ago, money was gold coins, gold and silver coins, pretty much predominated. They were in circulation. It was no big deal. Anybody'd have a silver dollar or some gold in their pocket, and they would spend it as legal tender. That was about 100 years ago. And then, along with that, slowly at first came gold-backed notes, where you'd just have a note, a piece of paper. It looked like a dollar bill, but it was a gold redeemable note. And if you ever wanted to, you could take that gold redeemable note, the dollar bill, and you could turn it in, and they'd give you the equivalent amount of actual gold for that note. It was an exchange note. It was a demand note. Well, those kind of gave way. They're long gone now. You can't redeem your U.S. or Canadian dollars for the equivalent price in a precious metal. Now we're just at what's called fiat currency, which means it's a currency by fiat, by dictate, which the government says it's worth $1. Okay, it's worth $1. I believe you. And that's it. It's not propped up or backed by anything. It just is $1 because they said it's $1. And so we're entirely in a fiat world now. Almost all money systems all around the world now are not tied to gold. They're not tied to a commodity basket. They're not tied to anything. They're just by dictate, by fiat. And now what we've seen is with the advance of technology, now we're really to the point of digital money. So we went from actual gold and silver, actual precious metal coins and money, to demand notes. Well, it's easy enough to take away what you could demand and just drift into fiat money. It's just cash. And now cash has largely just become digitized. Think about this. Think about all the money that you have in the world. If you had to go get your hands on it right now, in the next hour, how much of it is digital? How much of it is in digital form right now? Most of it is just a number that shows up on a computer screen when you log into your bank's website. Most of what you have is just a digital number on a computer somewhere. Most of all of our wealth is not stored in something of real value. It's in digits. It's in ones and zeros in a stacked array somewhere that's just strictly it's just strictly vapor. It's just digital. The fiat paper stage is almost gone. We're almost out of the cash age. It's almost gone. There's talk about eliminating the $100 bill because drug dealers and criminals use it a lot. There's talk about tracing anybody who spends those kind of securities, those types of currencies, notes that size. Interesting things. If you went to the bank, remember where you have the digits on a computer screen. If you said, this kind of concerns me, I think I'd like to take out at least $5,000 in cash and just stick it in my mattress where I'll feel more safe about it. If you went to the bank and tried to take out a $5,000 cash withdrawal, you remember it's your money. The bank has it because you deposited it. You put it there. But you'll have to show an ID, which protects you. You maybe have to sign some forms and possibly have a report filed by the bank to the U.S. government on you called a SAR, a Suspicious Activity Report. An SAR. If you go to take out $10,000, remember, it's your money. You put it in there. You deposited it. It's digital. It's written on the screen there. It should be yours for the taking. Why shouldn't you be able to convert it freely to U.S. or Canadian dollar? Why shouldn't you, depending on what country you live in? But in the United States, 10,000 or more requires that the bank fill out a currency transaction report, a CTR. So you could have an SAR filled out on you, could have a CTR. And to quote James Rickards, he said this. He said, there's an automated reporting network behind SARs and CTRs, and red flags filter up to the U.S. Financial Crime Enforcement Network called FinCEN, located in Northern Virginia near the U.S. intelligence agencies. If you ask for cash, you may not be a drug dealer, yet you will be treated like one by your bank. Isn't that interesting? That's our money. We put it in there. It turned into digital form, and if we try to take it out of digital form, put it back in physical form, we're suspicious. We're suspicious. Why? Well, because terrorists and drug dealers behave that way. And shame on them, and may they be shut down. But you, an innocent person, you're not allowed to do that because drug dealers and terrorists act that way. It impinges on your freedom. Now you're suspected because you want to take out $10,000 or more. So the digitization of money, let's call it that, digitization of money kills off our privacy, but also makes us liable to other things. Not only the cyber attacks that I talked about, not only the bail-ins by banks, but outright confiscation by government. Now, most of the people that are watching this video, you don't live under a government that's in the business of confiscating your money outright right now. But that kind of stuff happens in countries all around the world at times of war or dictatorships or military coups. That kind of stuff happens all over the place. You and I should be very grateful that we don't live in that type of situation, and may we propagate that type of freedom throughout the world. But what would prevent a government from doing direct taxation and just scooping it out of your accounts? Any of you that have had trouble with your finances or creditors, you know that if you get behind on taxes or money to certain municipalities and stuff, that they can sweep your account. You know, you go to the bank sometime, and because you're a little arrears and some payments to some certain agencies, if they can get a court order, they can sweep your account and it's just gone. So there's some forms of that, but there could be direct taxation in the future. How about redistribution of wealth? What if somehow some overpowerful government just decides that, that's too much money for these people having their accounts, we're going to take it from these and give it to those. And again, it's totally extreme, but when it's digital, it's so easily done. What about punishment for your politics? There have been all kinds of people who claim that the IRS investigates them because of their political stand on something or their opposition to some popular motion in society or something that's going on. There are people that claim that the IRS has been used as an arm of punishment for their political views. I don't know if it's ever been proven. I'm not trying to wave my hands and be a conspiracy theorist, but there are people that make those claims. Well, it's not that much of a step further to think that money could be confiscated or assets could be frozen, because it's so easy to do in the digital world if you don't march to the right political tune. What about a desperate government trying to survive? When governments go down, when there's military coups, governments don't go down without a fight. And a desperate government trying to survive, I don't know that it would be all that concerned about individual rights and individual wealth and the right to private ownership and privacy, and when it's a choice between the government, that particular government, standing or not. And there's extreme cases of this in the third world. Again, not where you and I live, but hey, what holds it back is just good laws and the enforcement of those laws and proper principles being followed by government, but there's no guarantee that lasts forever. Here's another one. Lots of people are very concerned that the U.S. dollar has been so inflated, and it's been the trade dollar of the world for so long, and lots of countries like Russia and Saudi Arabia are pulling back from using dollars for their oil purchases and everything else. Lots of countries are pulling back from doing that. If the United States dollar is no longer the exchange currency of the world, then what happens to the dollar? We're flooded with them. There's too many. And some people say, well, the U.S. with the big military, they could just reissue a new currency and say the dollar's junk, we're issuing this new currency, and everybody deal with it. And at that point, they could just do an automatic currency reissue. And because your money's digital and it's in a bank, they could say, yeah, I know you have $10,000, but that only equates to 1,000 of these new things or whatever. That kind of stuff could happen. Again, probably none of this will happen, but these are the things that people talk about. So, in addition to everything we've covered in the financial fitness teachings about all these particular asset classes, it's also a good idea to consider hedging against the dangers of digitized money, whether it be cyber attack or bail-ins or some misbehavior by government of whatever size. That's another whole reason to perhaps think about hedging your financial position against those types of calamities with something that's tamper-proof, with something like gold. The principle is this: you probably don't want the fruit of your labor all in one form. You probably don't want the fruit of your labor all in one asset, all in one currency, or merely as a number on a computer screen, or all in one investment like pile B. It might make sense to put a portion of it in gold and have a hedge of protection, as the prayer said, against all these crazy things we talk about. Now, by the way, like the one expert said, when times are good, having gold's about as exciting as watching paint dry. But think about this. You still had the paint on the wall for a reason. You're still glad to have the paint there, whether it's wet or dry. It eventually will dry. So having gold doesn't really hurt that much when you don't need it, but it helps a lot if you did need it. And maybe, come to think of it, we might want at least a little bit of Buffett's pile A while we very wisely follow his advice and start diversifying through pile B. And that's the answer I would have liked to have given my acquaintance when he asked the question, and I just didn't have time. But you had time and you had to suffer through it, so I hope you enjoyed it as much as he would have. Thanks for listening.